In this video, I'm going to be breaking down my analysis on PLTR stock, what their financials look like, where they're going, the big picture on why I'm bullish to begin with, and my price target for this stock. Plus, exactly what nobody is talking about with the way they changed how they build their contract. I'm not gonna waste any time. I'm gonna jump right into their quarterly financials to get started. This is their Q4 2020 financials they released in February. I think it's important for us to look at the numbers to get a sense for their business. $1.1 billion in revenue for full year 2020, up 40% year over year. Any company above 30% is an extremely fast-growing company, and that's precisely why this is on Cathie Wood's stock list. For full year 2021, Palantir said it expects revenue growth of 30%, slowing from 2020's 47% growth. And that's one of the main reasons why from February 19th to February 25th, the stock had a 17% dip. Now, I don't know about you, but let me put 30% growth in comparison with a similar company. PLTR has minimal competition, but I always like to think of Salesforce because both companies have software as a sales business models. Now, Salesforce.com reported sales increased 20% in the fiscal fourth quarter, the same year-over-year gains as the previous period. Now, what's interesting to me, and the reason why I bought more shares of PLTR, is that the deceleration in earnings is completely a non-issue in my opinion. Now that 30% is lower, but the reason they slowed is very deceiving from first glance to a retail investor. PLTR is shifting away from multi-year contracts with upfront payments to annual recurring revenue. So it's obvious to an expert investor and someone with experience that their revenues are going to appear smaller, but annual recurring revenue is better for the company long term. PLTR still expects Q1 2021 revenue growth of 45% year over year, so at the very least the next quarter of earnings are going to make a big difference for the stock's price. That's probably because they're still realizing revenues from their new contracts, which include Rio Tinto, PG&E, BP, US Army, US Air Force, FDA, and the NHS. Looking at their balance sheet, their cash also went from $1 billion to over $2 billion. And on the other hand of things, what I really like to look for in a strong financially sound company is if you take a look at the total liabilities, they have also decreased. All good signs of a financially well-run company. One thing to keep in mind is that PLTR's key advantages is its steady and growing government business. They had $610 million in revenue from government customers in 2020. And here's another thing I need to mention that I think nobody is talking about that will drive PLTR stock to $50 per share by 2021 and $100 per share by 2022, and also a $100 billion market cap. Let me break down this image for you. On the left side, revenue from their top 20 customers is increasing. That means the customers they already have like their services and are spending more to upgrade and expand their business. That's all well and dandy, but what happens when the top 20 customers become the entire revenue stream for PLTR? Aren't they going to be too concentrated and reliant on their top customers? Well, not really. That is just not the case. The right-hand chart says actually, customer concentration of our top 20 customers as a percentage of total revenue is decreasing. So folks, we have a double whammy here in terms of picking a stock to get stupid rich with, because not only are revenues rising, but the company is becoming much less risky, and I doubt a majority of investors realize this if they're just following Cathie Wood or just reading about this stock on Reddit. So on the bigger picture, here's why I think this stock is an opportunity right now. We have a few things going on, like the company signing more contracts on a recurring basis, lowering expected 2021 growth in the short term, bumming out the shorter term traders. But on the long-term investor side, they are licking their chops at a growing diversified revenue stream that PLTR is about to be pulling in for many years to come. That's why I believe in their potential to grow much bigger than their current value. $100 per share is what my price target is for this stock. Now, companies like PLTR and NEO for that matter are virtually guaranteed success when the country's government is directly involved. PLTR can double from the current levels when people start figuring out the advantages PLTR has in their lucrative field. Even under $30 per share, I'm a buyer of PLTR stock because long term, there is no competitor that is going to jump in and compete with what PLTR has already built. This is a stock I'm bullish on because of the long-term outlook. Cathie Wood knows what she is doing when it comes to innovation, and her recent purchases only confirmed my previous analysis on PLTR. I was talking about PLTR before they even IPO'd because I know that they had a lot of government contracts, and that was something that I looked for in terms of revenue stability. Now guys, there is another stock I want to discuss here because this is the biggest stock Cathie Wood just loaded up on. I'll put it up on the screen, and as you can see, it's pulled back a lot. Cathie referred to Teladoc Health, ticker symbol TDOC, as a potential healthcare powerhouse. She's really put her money where her mouth is, and she's been loading up on this stock. Now, Teladoc ranks in her top 4 holdings of their ARK ETFs, and its #1 position in the ARK Genomic Revolution ETF right now. Teladoc is the global virtual care leader. Its telehealth services are used by more than 40% of Fortune 500 companies, plus a much greater number of smaller organizations. Over 70 million people in the US have access to Teladoc's telehealth services. Now guys, what I find attractive is this stock had a price to sales ratio of 24, which is a Tesla-like valuation, but it's currently sitting at 16.5. The valuation has come down tremendously. When I saw shares of Teladoc trading around $200 a share, I got very excited. Besides getting caught up in general tech sell-off, some investors who piled into Teladoc last year have started heading for the exits, and they would think that the growth story is all over or potentially over, not that the economy is starting to reopen up and vaccinations are out there, but that simply just isn't the case. The Q4 2020 update was very positive in my opinion, and besides delivering year-over-year revenue growth of 145%, by the way, organic growth was about 79%, excluding the InTouch Health and Livongo acquisition, the company expects full year 2021 revenue to nearly double again to as much as $2 billion over the 2020 total of $1 billion. If you ask me, I hate going to the doctor. I much more prefer a virtual visit because I don't have to drive anywhere. After falling more than 30% from all-time highs, I think shares are priced at a reasonable price to sales ratio given the company's expected growth and the size of the industry that it's making waves in. Even after the economy opens back up, I think online doctor's visits will still stay around. Teladoc has enormous growth prospects within its existing client base. There are nearly as many potential users at clients who currently subscribe to the company's telehealth services as there are individuals who already use the service. So guys, you really need to listen to this. They have already captured a large part of the market. Just like Webull tries to acquire customers by giving them free stocks because they hope that those users will make them money long term. Yes, those free stocks are not completely free. Webull hopes to make some money in the future off of those promotions, and Teladoc has pretty much solved that problem of user acquisition. They do not need to worry about giving free stocks or any free things out to customers because they have already built a very large customer base. That's the most important thing in any tech company, and that's what makes me bullish on Teladoc stock. The company also has a tremendous opportunity for cross-selling its products. Around 18 million individuals at current Teladoc telehealth clients are candidates for Livongo's digital health management platform. Now, McKinsey, that's the international consulting company, they think that the virtual care market will approach $250 billion annually in the US alone. Now, you guys know that Teladoc generated revenue of about $1 billion, which actually is less than 0.5% of its projected addressable US market. So to say there is a long roadmap of profits ahead for Teladoc, that is actually an understatement. I don't currently have any shares, but I am planning on buying some in the ARK-H portfolio that I manage over on Patreon. If you want to follow my daily alerts and trades, make sure to check out the Patreon link below. You can also direct message me. I love engaging with my patrons. It really helps me out, helps the channel out. And by the way, guys, I do read all of your comments. Thanks so much for making this far in the video, and I will see you guys in the next one. Be aggressive in learning, but be safe in investing.
No one ever sees me.